Hello. In our previous topic, we learnt about objectives, advantages, and limitations of accounting. Before moving further, let's talk about some basic concepts of accounting. So, we will discuss about accounting terminologies. Let's start from business transactions. A business transaction is an activity or event that can be measured in terms of money and which affects the financial position or operations of the business entity. In other words, the economic event that relates to a business entity is called business transaction. For example, sales, purchase, cash paid, cash received, assets purchased, etc. Next one is proprietor. We go to market to buy items of our daily needs. In the market, we find a variety of shops. Some of them are small and some of them are big. We may find some persons selling vegetables, peanuts, newspapers, etc. on the roadside. We may also find cobbler repairing shoes on the footpath. Every day you come across such types of shops in your locality. But have you ever tried to know how these businesses are run? Who are the owners of these businesses? You may say the owner invests capital to start the business, take all decisions relating to business, looks after the day-to-day functioning of the business, and finally is responsible for the profit or loss. Yes, you are right. If you go a bit further, you will find that in some businesses a single individual and in some businesses a group of individuals perform all these activities. So, an individual or group of persons who undertake the risk and invest funds into the business as capital to start a business is known as proprietor. Next concept is capital. It is the amount invested by a proprietor in the business to start a business. It can be in cash or kind, assets like machinery, furniture, property, etc. For example, Mr. Peter brought assets worth $6,000 and cash $10,000 into his business. Now these assets and cash are capital for his business. Next concept is drawings. It is the amount or benefit withdrawn by the owner from the business for personal or domestic use. It may be in the form of cash, goods, or assets. For example, Mr. John took out $2,000 from his business for his personal use. Now this is known as drawings. Moving on to the next term, that is assets. An asset is a resource with economic value that an individual, corporation owns or controls with the expectation that it will provide future benefit. Assets are reported on a company's balance sheet and they are bought or created to increase the value of firm or benefit the firm's operations. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, improve sales, regardless of whether it's a company's manufacturing equipment or a patent on a particular technology. For example, cash, machinery, furniture, etc. Assets can be classified as fixed assets, which is further classified into tangible and intangible assets. Next one is current assets, that is further classified into liquid assets, fictitious assets, and wasting assets. Next terminology is fixed assets. An asset that is not consumed or sold during the normal course of business, such as land, buildings, equipments, machinery, vehicles, leasehold improvements, and other such items. Fixed assets enable their owner to carry on its operations. In accounting, fixed does not necessarily mean immovable. Any asset expected to last or be in use for more than 1 year is considered as fixed asset. On a balance sheet, these assets are shown at their book value, that is, purchase price less depreciation. These assets can be further classified as tangible and intangible assets. Let's start with tangible assets. These are the assets with physical appearance. These can be seen and touched. Revenue generation is possible with these assets. Tangible assets include both fixed assets such as machineries, buildings, and land, and current assets such as inventory. Some of the common examples of tangible assets are land and building, plant and machinery, and furnitures and fixtures. Second one is intangible assets. These are the assets with no physical appearance. The assets that cannot be seen and touched are called intangible assets. Examples of such assets are goodwill, patent rights, copyrights, trademarks, franchisee and licenses, etc. Next one is current assets. Current assets are balance sheet accounts that represent the value of all assets that can be reasonably expected to be converted into cash within 1 year. Current assets include cash and cash equivalents, accounts receivable, inventory, marketable securities, prepaid expenses, and other liquid assets that can be readily converted into cash. Current assets are important to businesses because they can be used to fund day-to-day operations and pay ongoing expenses. Examples of current assets are cash in hand, cash at bank, debtors, stock, prepaid expenses, outstanding income, etc. Moving on to the meaning of liquid assets, an asset is said to be liquid which is easy to sell or convert into cash without any loss in its value. All current assets except prepaid expenses and stock are liquid assets. Examples of liquid assets are cash in hand, cash at bank, debtors, bills receivables, short-term investment, outstanding income, etc. Next one is wasting assets. Assets whose value goes on declining with the passage of time and usage are known as wasting assets. Examples of wasting assets are coal mines, oil wells, minerals, or other natural resources. The last one is fictitious assets. Fictitious assets are those assets which do not have physical form and real value and cannot be converted into cash. These assets are the types of losses. These are sometimes also called as deferred revenue expenditure. Examples of these assets are discount on issue of shares or debentures, advertisement suspense account, profit and loss debit balance, and the last one is preliminary expenses. Thank you.